Good evening. I am going to cover new strategy of options which is called as Condor option strategy. I already covered long call butterfly and short call butterfly. Time fair for trade can be taken 15 minutes or this can be used for swing trading, trade setup. Stock market should have in bear or bull condition, trade with primary trend and good quality of volume. Trading preferred time you can take in the first half because second half market direction is not clear, so I will not recommend you to trade in second half. If you know the direction is clear, index direction is clear, specific sector index direction is clear, you can take a trade from 1:40 p.m. Avoid trading strictly between 11:30 to 1:40 as market is most of the time sideways or range bound. If you buy or sell because of range bound market, you are going into losses. So let's go ahead with Condor. I am going to cover two kind of Condor. One is long call, another is short call. I will let you know examples also so you have clear picture in your mind. So let's go ahead. The Condor option strategy is a limited risk non-directional optional trading strategy that is structured to earn limited profit when underlying security is perceived to have little volatility. So you must see the VIX, and volatility means implied volatility. I already covered implied volatility in the second chapter, and volatility, implied volatility has very important role in option. So you must go through and read and try to understand each micro level point. So so this is long call Condor. For construction, long call Condor, sell one ITM call, buy one ITM call lower strike, sell one OTM call, buy one OTM call higher strike. So these four things you have to make the combination. Using call option expiry on the same month. All these ITM OTM expiry must be same month. The trader can implement a long call Condor option spread by writing a lower strike in the ITM, buying any even lower strike in the money ITM, writing a higher strike out the money call and buying another even higher strike out the money call. A total of 4 legs involved in this Condor option strategy and net debit is required to establish the position. If anybody is not able to understand ITM, OTM and ATM, please refer to my first video. I have already covered in basic of options and that is in very much detailed. So let's understand first the purpose of Condor spreads. The purpose of Condor strategy is to reduce the risk, but that comes with the reduced profit potential and the cost associated with the trading several legs. Condor spreads are similar to butterfly spread because they profit from the same condition in the underlying asset. The major difference is the maximum profit zone or sweet spot or for a Condor is much wider than the butterfly, although the trade-off is lower profit potential. Both strategies use options either call, all calls or all put. As a combination strategy, uh, a a Condor involves multiple options with the identical expiry dates, purchased and sold at the same time. For example, a long call Condor Using calls is same running both an in the money long call or pull call spread or out the money short call or bear call spread. Unlike the long butterfly spread, the two sub strategies have 4 strikes instead of 3. Maximum profit is achieved when the short call spread expire worthless while underlying asset closes are above the higher strike price in the long call spread. So this is the diagram for long call contour. You see that in x axis gains at the top, sorry, y axis gains at the top, and x axis you see underlying future price. So long call lower outer strike, then short call, then short call higher inner strike, long call higher outer strike. So by these combinations you should use the same. So contour options strategy, profit or loss, 200 minus 300, then again it is in y axis and x axis strike price at expiry 35, 40, 45. These examples will be used in long call contour. So please try to correlate and try to understand. You must use your logic in options in all the strategies. So long call contour, limited profit. Maximum profit for the long call control option strategy is achieved when the stock price flies between two middle strikes at the expiry. It can be derived that the maximum profit is equal to difference in strike price of two lower striking calls less the initial debit taken to enter the trade. The formula for calculating maximum profit is given below. Maximum profit equal to strike price of the lower short call minus strike price of the lower strike long call minus net premium paid minus commissions paid. Maximum profit achieved when the price of underlying is in between the strike price of the two short call. Limited risk. The maximum possible loss for the long call contour option strategy is equal to initial debit taken when entering the trade. It happens when the underlying stock price on the expiry date is at or below the lowest strike price and also occur when the strike price is above the highest strike price of the option involved. You can calculate the maximum loss equal to net premium paid plus commissions paid. Maximum loss occurs when the price of underlying is less than or equal to strike price of the lower strike long call or price of underlying is greater than or equal to strike price of higher strike long call. So there are two break-even points in long call contour. The break-even points can be calculated by using formula upon break-even point equal to strike price of highest strike long call minus net premium received lower break-even point equal to strike price of lowest long call plus net premium received. So let's go ahead with example. I will go to again this diagram. So please try to correlate with contour option strategy. This is a long call contour option strategy. So let's suppose a XYZ stock is trading at 45 rupees in June. An option trader enter a long call trade contour trade by buying a July 35 call for rupees 1100 and writing a July 40 call 700 rupees, another writing July 50 call for rupees 200 and buying another July 50 call for rupees 100. The net debit required equal to 300, which is maximum possible loss. To further see why 300 rupees is maximum possible loss, let's examine what happens when the strike price fall to rupees 35 to rise rise to 55 on the expiry. At 35 all options expire worthless, so initial debit taken rupees 300 is maximum loss. So instead of expiry in the July, XYZ is still trading at 45. Only the July 35 call and July 40 call expire in the money. With his long 35 calls worth 1000 to offset to short the July 40 call and value of 500 and the initial debit 300, net profit comes to 200. The maximum profit for contour trade may be low in relation to trade in strategies, but it has comparatively wider profit zone. In the example, maximum profit is achieved if the underlying strike price at expiry is anywhere between 40 to 50 rupees. So this is the long call contour. So let's go ahead. Contour types. So there are four types of contour types. So first is long call contour with calls. The second is long call contour with puts. The third is long call contour with calls. The fourth is short call contour with puts. So you see the combination long call contour calls. This result in the net debit to account buy a call with lower strike A. I will show the diagram so you will able to correlate. You see this is the diagram ABCD, profit and strike price. Y axis profit at the top and this 0 is point, then losses, then strike price at the expiry. This is contour spread diagram, long put long call and profit loss. So these three diagram, short call, long call, long call, long call. So this you have to correlate, you have to use your skills into that. So long call contours, buy a call with strike price A, lowest strike, sell a call with strike price B, second lowest, sell a call with strike price C, the second highest, buy a call with strike price D, highest strike. At the inception, the underlying asset should be close to the middle strike B and C. If it is at the middle, then the strike price take on slightly bullish or bearish band. Note that the long butterfly strike B and C should be the same. The second is long contour with puts. This result in net debit into account buy a put with a strike price A, sell a put with the strike price B, sell a put with the strike price C, buy a put with the strike price D. The profit curve is same as the long call contour with buys. This is long call contour with puts. Next is short call contour with calls. This result in the net credit into account. Sell a call with a strike price A, lowest strike, buy a call with a strike price B, second lowest, buy a call with a strike price C, the second highest, sell a call with a strike price D, highest strike, short contour with puts. This result in net credit into account. Sell a put with a strike price A, lowest strike, buy a put with a strike price B, the second lowest, buy a put with a strike price C, the second highest, sell a put with a strike price D, the highest strike. The profit curve is same as for the short cut contour with calls. So these are four types. Just try to understand whatever in your brain it's capturing, you capture it. These all things I am telling you options in very broad detail, so you must know all the things and you use the strategy at which you are confident, otherwise don't use it. It's up to you. So this is the diagram, you see that this is the diagram. So let's go ahead, I will take one example only, example of long contour with the spreads. So you have to use this diagram. I will show you profit ABCD, profit loss. So let's go ahead, the example of long contour with calls. Let's leave that. I will cover short contour with puts because long contour you already covered. So the example of contour spread with puts. The goal is to profit from projected high volatility and underlying asset price moving behind the highest or lowest price. The maximum profit is net credit received from implementing the strategy minus any commission. Maximum risk is the difference between the middle strike price at the expiration minus cost to implement. In this case, a net credit and commissions two break-even points BEP1 where the cost to implement is added to the lowest strike price and BEP2 where the cost to implement is subtracted from the highest strike price. Sell 1 ABC 60 put at 6.00 resulting into credit of 6.0 rupees. Buy 155 put at 2.5 resulting in a debit of 2.50. Buy 1 ABC 50 put at 1.50 resulting in debit of 1.50. Sell a put 45 put at 0.45 resulting in a credit of 0.45, net credit is 2.45. The maximum profit is 2.45 less commissions. The minimum risk is rupees 5 minus 2.45 equal to 2.55 plus commissions. So what are the key takeaways? A contour spread is a non-directional option strategy that limits both gains and losses while seeking to profit from either low or high volatility. This is the first. The second is long call contour seeks profit from low volatility and little to no movement in the underlying asset, while short call contour seeks profit from high volatility and large movement in the underlying asset in either direction. Contour spread is a combination strategy that involves multiple options, purchase and sold at the time. So these are the takeaways. These are the diagrams. So friends, please remember I have covered two strategies in this together. First is the long call contour, then short call contour, how it is formed, then the contour options, then the diagram, then long call contour, how it can be calculated, limited profit, limited risk, maximum loss, break even points. Then one example has been taken, you tried. Once you do, these things are very simple. Then how many types of contour types? There are four: long call contour with call, long call contour with put, then short call contour with call, then short call contour with puts. Example of long call contour with contour spread calls, we already covered long call contour, so it's not, you can go through. Then the second one I already covered, example of short call contour with the puts, so this has been covered. Then there are key takeaways, there are three key takeaways. Then this is the diagram, long call contour. Then this is another diagram that has been explained, and you can see on those basis this has taken. So friends, I covered you short call and long call contour. You must go through all the strategies and you implement whatever best for you and where you have the comfort. My job is to tell you everything for your learning purposes. How much you grasp, it is up to you. But put your hard work and try to do paper trade option. People are not aware too much options in India. They only sell call and put, and independently selling call and put is not the option. Option is just like water. If you take water in your hand, you cannot catch it. So if anybody is telling you to do sell call or sell put, avoid that. I am saying strictly avoid. These are the basic payoff. The combination on that option strategies are built up. So if someone is saying he is not aware of options, so please avoid strictly. Have proper trade and take a training from NSE certified option analyst and ask his reference certificate number. whether it exists or not exist is also matters, because he might not aware options. In in stock market, all courses are updated regular basis, so you must have latest update, otherwise you will not able to trade, you will not able to get profit. So friends, this is from my end. I tried you to provide best information for your learning purposes. Please subscribe video in case of now subscribe. Try to go through all videos and learn more. I can tell you, you have a clear cut concept. Build your concept, then have a paper trade, then trade. Please remember, this market will always open Monday to Friday. It is not going to close. It is throughout life. So keep patience. This all will help you to build up your confidence. Thank you friends. Good night. Take care.